So, 2021 is barely 7 weeks old. Let's briefly look over what's happened in these frenetic first 7 weeks of the year. First, we had Bitcoin hitting a record high, and then as regulators got involved and threatened regulation in the near future, it then plummeted 30%. Subsequently, we had Elon Musk getting involved. He subsequently converted around about 10% of Tesla's spare cash into Bitcoin, as a result of which it hit a new record high, and that was only in the first few weeks of the year. What else has happened? Well, who could forget GameStop and the other meme stocks? This was when a small group of Reddit traders got together to inflate the price of a handful of American companies which previously had been shorted by a bunch of hedge funds. Now, why was this important? Well, because it showed that hedge funds don't always have to have the upper hand. In fact, it showed the collective power of a little trader against a set of hedge funds, so much so that you had hedge funds like Melvin Capital writing off $13 billion in losses just on one stock. How crazy is that? Now, if these two events are precursors for what's going to happen in the next 10.5 months as we go through 2021, it's going to be one hell of a bumpy ride. So, with all that said guys, strap in, let's jump into the video and see what my outlook on 2021 is going to be like. So, there's been a lot of talk recently about how we might be approaching an asset price bubble. So, with that said, let's look back at previous bubbles and let's see whether or not there are any telltale signs that happened in those occasions that may be telling us where we're about to go in the very near future this year. After all, it's been said before that history does not repeat itself, but it does rhyme. So, in this video, we're going to look at 3 key components of asset price bubbles: prices, valuations, and the wider economy. So, let's have a look at asset market prices, shall we? So, as we can see from this chart right here, from the period of 1996 to 1999, in the run-up to the dot-com market crash, we can see that the S&P 500, which is the index of the 500 biggest firms in America, shot up by 97%. Yes, that's right, it almost doubled in a space of 3 years. Let's compare that kind of stock market appreciation to what's happened from 2018 to now. We can see over the 3-year period from 2018 to now that the S&P 500 has increased in value, considerably in fact. It's probably up around about 50% or so. Now, that's a very big jump over a 3-year period, but as I'm sure you'll agree, it's not even close to almost doubling like it did do in the 3 years from 1996 to 1999. But that's just the US. Now, let's look internationally. So, one proxy for international stock markets is the FTSE All-World Index, which in the past 3 years or so is up, but it's only up around about 30%. A solid return, but it's nowhere near the return of the S&P 500. So, just looking at stock market prices, what's the verdict? Are we in a bubble? Well, I'm going to suggest not, or at the very least, not yet. But I think what is clear so far is that if we are going to be heading towards a stock market bubble, then it's going to be the US which is leading the way. Now, the second metric that we're going to look at in this video is stock market valuations. Now, a standard metric of stock valuations is something called the price-earnings ratio. And what the price-earnings ratio does is it takes a current stock price and divides it by that company's earnings. So what it tells you in practice is the number of years of current profitability that that company would have to sustain in order to justify the price. And as we can see from this chart right here, the PE ratio is at historic highs. In fact, the price-earnings ratio right now for the world's leading companies is really quite high. So much so that the only time in recent history that it's been higher has been just before the dot-com bust in the year 2000. So, on a PE ratio at the very least, we can say that stock markets are approaching overvalued territory. But that's stock markets as a whole. Let's look at some of the individual companies which make up these stock markets. So in this chart, we're going to compare the price-earnings ratios to some of the hottest companies just before the dot-com bust and some of the hottest companies right now. We can see that in 1999, just like now, a lot of the price-earnings ratios for some of the hottest companies were exploding. In fact, let's look at one of these bubbles on the right-hand side of the chart, one of the much smaller ones. Let's look at Tesla. Tesla's price-earnings ratio now is around about 209. So that means that at current profitability, you would have to hold Tesla stock for 209 years in order for it to be profitable enough over that period to be able to justify its current price. Now, I'm sure Elon Musk and Tesla fans out there are going to be arguing, quite rightly, that Tesla is going to be increasing profitability, or at least trying to increase profitability over the next number of years. The only question is, can it increase its profitability enough, fast enough, before investors start losing hope in the company? After all, guys, let's not forget, Tesla, one car company, is currently valued at more than Toyota, VW, Ford, General Motors. One company in the automotive sector is currently valued at more than the vast majority of the rest of the sector combined. That is literally mind-blowing. If that doesn't tell you that this company is in danger of being ridiculously overvalued, then I don't know what will. Let's just remember what happened in the aftermath of the 99-2000 dot-com bust. A lot of the companies which people at the time thought were going to be around for years and years and were going to revolutionize the way we lived at the time plummeted by 90+%. In fact, Amazon at the time plummeted by about 94%. But as it turned out, Amazon was one of the lucky ones because it survived, it's still here today, and Jeff Bezos is among the richest people in the world. So, for those investors who invested just before the dot-com bust in Amazon, they would have seen their shareholding wiped out. Whereas those who invested at the very bottom of the dot-com bust will have made many thousands of times on their returns. So the point here, guys, is that single stock investing in hot sectors right now is incredibly risky. So, what might be a better approach? Well, a better approach could be to look at those sectors which have been overlooked or overshadowed by the lockdowns. Look, for example, at sectors focused on consumer goods. These sectors have been downtrodden simply because people haven't been able to go and shop as much, and so there hasn't been as much economic activity as would otherwise have been the case. That could be a recovery play. But as always, guys, do your own due diligence. Now, we've looked at prices and we've looked at stock market valuations. So let's look at the bigger picture. Let's look at the wider economy. We're going to look at three metrics of the wider economy. We're going to look at unemployment, we're going to look at interest rates, and we're going to look at the money supply. So let's look at unemployment. Well, in the UK, it's currently around about 5%. Now, as we can see from this chart right here, the current unemployment rate is not very high by historical standards. In fact, it's near a record low by historical standards. Now, that's partly because of furlough and other government interventions. So it's potentially the case that the unemployment rate is being kept artificially low, and so we'll see a jump in unemployment when all of the government support ends up getting wound up over the next few months. And that could potentially be a bad sign for the economy if unemployment gets up to around about 8 or 10% or so. Next, let's look at interest rates. So, as you can see from this chart right here, interest rates globally have been trending in one direction over the past decade and a half. That direction has been downwards. So because interest rates globally have been trending downwards, that has led to the situation where there has been no point in holding your money in cash. Because by investing money in cash in a bank account, you're in fact making a negative rate of return. So a lot of people's excess cash has been invested in the stock market and in other places. And as long as interest rates stay low, we can be pretty certain that stock market returns are going to stay high as investors seek out those high returns. So the third economic indicator that we're going to look at is the money supply, as measured by quantitative easing. So, like I covered in previous videos, quantitative easing is the process whereby central banks print money by buying up government debt. How much money has been printed like this? Well, as we can see from this chart right here, the global total stands at about $23 trillion, led largely by the US, the Bank of Japan, and the European Central Bank. By comparison, the amount of quantitative easing in the UK has been comparatively tiny. So, with that said, we can be pretty sure that the biggest determinant of stock market prices in 2021 is going to be continued loose monetary policy. So what we need right now, in order for stock markets to keep trending higher, is for governments and central banks to keep printing more money, so then that money can be invested by investors seeking a return in the stock market. And as things stand right now, there is very, very little sign that governments around the world are going to be pressing pause on that money printing machine. Now, given there's so much money being printed, I can practically hear those of you at home screaming at your screens, what about inflation? What's going to happen, Steve, with inflation? If so much money is being printed, then surely that's going to lead to a massive rise in inflation in the very near future. Right? Well, actually, I'm not entirely convinced that inflation is guaranteed to follow. And there are two reasons for this. Because consumers are going to be uncertain about maybe keeping their jobs, they're going to be less likely to go out and spend a lot of their money. And so because there's going to be subdued consumer spending in the economy, there's not necessarily going to be enough of a trigger for inflation going forwards. And of course, the second reason is much more fundamental. Many of the world's economies are still locked down. And as a result of that, there's not very much that you can actually buy. And so, if there's not very much that you can buy, and consumers aren't very certain about their economic prospects, and so they aren't going to be going out to buy as much anyway, then that all leads to a slowdown in consumer activity, which means there's going to be very little of a risk of inflation, because there's no real place where that inflation can come from, because our economies are largely driven by consumer activity. If there's no consumer activity, then there's no increase in prices, and so as a result, there can be very little inflation. So let's summarise. We've said that stock market prices, while high, are not as high as they were in 1999-2000, but they're certainly trending in that direction, led very much by the USA. Now, stock market valuations, at least as measured by the price-earnings ratio, are a huge red flag. So what does that mean? Well, it just means that investing in single stocks in hot sectors right now is inherently risky, because we know that a lot of the companies which operate in hot sectors are at or near record highs. So, like I said before, a recovery play could potentially be investing in those sectors which have been overlooked. Some of these might be sectors which are dedicated to consumer spending and commodities, which have both been hit hard by COVID-related shutdowns over the past year and a half or so. So, with all that said, guys, here are a few tips for investing in 2021. Firstly, one of the most important things you can do is always keep an emergency fund to one side. That way, if you do end up becoming unemployed, or if in some other sense the worst happens, you have money set aside which you can fall back on. So, beyond that, we know that hiding under a rock is a bad idea because you miss out on investment returns. We also know that jumping into the market is also a bad idea because you risk jumping in at just the wrong time. So what's a much better idea? Well, a much better idea is to drip feed your money into stock markets. That way, if it does turn out we're in a bubble, then you can take advantage of cheap stocks once the bubble bursts. Equally, if it turns out that we're not in a bubble and stock market prices do keep rising, you can keep riding the wave upwards by continuing to invest over a sustained period of time. So guys, that's all I have for you in this video. If you found it useful, and for more content like this, be sure to smash the like button and also subscribe to my channel. In my next video, out in just a few days' time, I'll be talking about some strategies that you can use to mitigate risk in your portfolio. And so guys, stick around and I'll see you in a few days' time.